Tax the rich. 3 words. A simple slogan. Or perhaps you've heard another argument. How can there be so many billionaires while children are starving? It's a powerful question, and for many people, the answer seems obvious. If the richest people simply gave up more of their wealth, couldn't we fund free universities, build affordable housing, expand public transportation, and reduce poverty? It sounds reasonable. Promises like these helped New York City, new mayor, win over many voters. But today, we are not talking about politics. We are asking an economic question, not is it fair? The question isn't whether poverty exists. The question is whether taxing accumulated capital is a mechanism that actually solves it. So let's ask a different question. Can a society become permanently wealthier by taxing its richest citizens more heavily? Meet David. 20 years ago, David founded a software company. Today, his company is worth $14 billion. His personal net worth is around $12 billion. When people hear a number like that, they often imagine an enormous vault filled with cash. But that's not how wealth works. David doesn't have $12 billion sitting in the bank account. Almost all of his wealth exists in ownership shares in his company. That company owns data centers, patents, office buildings, machinery, software, thousands of employees, research projects. His wealth doesn't exist as cash. It exists as productive capital. And that's where our story begins. Now imagine the government announces the richest should pay more. David received a tax bill for several $100 million. Where does the money come from? He has 3 options. He can sell company shares. He can reduce future investments. Or he can sell productive assets. No matter which option he chooses, this isn't simply money moving from one account to another. It changes human decisions. Investment plans change, expansion plans change, hiring plans change. And this is exactly where praxeology begins. Economics starts with human action. Most people immediately ask, how much revenue will the government collect? But Austrian economics asks a different question. What will never happen because of this decision? Maybe the company planned to build another factory. Maybe it wanted to finance 10 startups. Maybe a new cancer treatment would have been developed. Maybe an AI infrastructure project would have expanded. None of those losses appear on a government budget because they never happen. Bastiat called this the seen and the unseen. The tax is visible, the opportunities that disappear are not. Now, meet Sarah. Sarah works as a software engineer at David's company. She isn't wealthy. She isn't a shareholder. She simply writes code. Why does Sarah earn far more than programmers earned 30 years ago? Not because politicians became more generous. Not because society became more moral. Because Sarah is surrounded by capital. Powerful servers, advanced software, automation, AI systems, infrastructure. Each of these allows Sarah to produce far more value every hour she works. The more capital available to each worker, the higher that worker's productivity becomes. And over time, higher productivity leads to higher wages. Capital raises labor. Labor doesn't create capital first. Many people think wealth is simply money sitting somewhere. But capital isn't a pile of money. Capital is an ongoing production process. It isn't static. It's a structure built across time. Entrepreneurs coordinate resources. Investors postpone consumption. Workers specialize. Machines are built. Knowledge accumulates. Production becomes more efficient. A company isn't just a bank account. It's a constantly evolving network of plans about the future. And this is where everyday institution begins to fail. This brings us to one of Ludwig von Mises' most important insights. There are two fundamentally different realms, and confusing them creates endless misunderstandings. The first is the realm of human action. People choose, they save, they invest, they take risks, they respond to incentives. This is the realm of praxeology. The second is the realm of politics and value judgment. Words like fair, unfair, too much, too little. These are not economic concepts. They are moral or political judgments. Both discussions are legitimate, but they are different discussions. The mistake is treating a moral conclusion as though it were automatically an economic fact. Mises separates them completely. Economics doesn't tell us what society ought to value. It explains what follows when people act. From this perspective, the difference between markets and government isn't primarily moral. It's structural. Markets coordinate millions of decentralized decisions. Profit and loss constantly redirect capital toward consumers' preferences. Resources flow according to voluntary exchange. Governments coordinate resources differently. Investment decisions become political decisions. Capital is redirected through taxation and public spending. Resources follow political priorities. Neither description automatically means good or bad, but they generate different incentives. And different incentives produce different patterns of production over time. Notice how the discussion has changed. The question was never simply, how much money can we collect? The real question is, how does taxation change investment, capital accumulation, entrepreneurship, and future production? Because prosperity isn't a fixed amount waiting to be divided. It isn't a pie. Prosperity is a process. It emerges when people continuously reorganize capital, discover better ways to produce, take entrepreneurial risks, and coordinate millions of individual plans across time. Tax the rich is a simple slogan. So is there are billionaires while children are starving. Both statements appeal to our moral institution, but economics asks a different question. Not whether inequality exists, not whether poverty exists, but how human action changes the future. The Austrian school begins where people stop looking like numbers and start looking like individuals making choices under uncertainty. Because that's where prosperity is ultimately created, not by redistributing existing wealth, but by continuously creating new wealth through entrepreneurship, investment, and capital formation. And that's the difference between a political slogan and an economic explanation.